All right. Welcome, everyone, to the second edition of TradeView Live in 2026. I'm your co-host, Ben Tracy. I lead strategic business development at Vizion, joined here by my fellow host, Kyle Henderson, Vizion's CEO and co-founder. And we have a special guest today, Yann Barbarroux of Otonomi. Yann, thanks for joining us.
Hey, everyone. Thanks a lot for having me. That's a pleasure.
Wonderful. We're very glad to have an expert in a field that Vizion just doesn't operate a lot in terms of insurance, and so really excited to get your input on what's been happening as we go through some of the insights over the last couple of weeks. All right, Kyle, we'll go through our disclosures for anyone joining for the first time. We like to just orient you in terms of what we're talking about and where this data comes from. So let's start with TradeView. Kyle, what is TradeView?
Yeah, thanks, Ben. So this session is called TradeView Live. TradeView is a product and solution offering from Vizion. In short, it's the industry-leading trade intelligence, 3 times more trade coverage than any other platform out there, the only forward-looking trade intelligence platform. We profiled more than 1.5 million companies, created 90-day trade forecasts, have mapped out supplier and product networks, and there's AI researchers built into this to deliver custom insights as well. Different packagings depending on the needs you have. But fundamentally, TradeView is the data, the product, and the solution we use to drive the insights for this presentation.
And there's a lot of data.
We take it live.
Yeah, we take you live through it, live data. But there's a lot of different data elements from bookings to metrics to forecasts. Kyle, where does this data come from?
Yeah, we get that question frequently, so we have an answer, and it's from 270 different proprietary data sources we've built up over the past 5-6 years. That's connections to carriers, ports, terminals, rail carriers, ocean carriers, trucking carriers, customs agencies, bring in data sources like vessel tracking, AIS data, et cetera. So there's a host of different types of data sources, and then even those types, there's a host of different sources or parties we pull in data from to make sense of what's happening in the world.
And in terms of forward-looking information, which we'll go into a few of those later in this discussion, how are we able to forecast what will happen?
One of the key data sources in TradeView is the access Vizion has to bookings with major ocean carriers since the time the booking was placed. So we're able to see planned shipments weeks in advance of their departure, and therefore weeks or months in advance of their arrival. And that helps us better understand what's happening across the world and forecast the future with a great level of accuracy and precision.
Thank you. So speaking of what's happening around the world, everything from Davos to Iran to India and the US to even South Korea, all of this has happened since we last met 2 weeks ago.
And the Suez.
Don't forget about the Suez Canal, right? Panama Canal, I think, yesterday as well. So I like to start with just at a high level, what's going on globally in the world of shipments. We've walked through this for the last, 9 months, every 2 weeks, giving a snapshot to our audience in terms of changing in global shipping behavior. But I want to pause here and let our guests speak a little bit about, Yann, what you've experienced over the last 10 months. And I'm thinking back roughly to late March, early April of 2025, when the world sort of got turned upside down in terms of trade policy and tariffs. But there's obviously been so much else happening, from the Ukraine war to the war in Gaza to the Red Sea. How does the insurance industry, how has the insurance experienced the last 12 months?
Yeah, so I think it feels like a decade ago when you talk about 10 months ago at that point. Obviously, there's one very big risk factors that we went through is obviously the new administration in US that's been kind of like injecting a lot of rippling effects and kind of like establishing a new order, right? And for better or worse, if you think about it. For in our case, it's pretty ironic, right? So each time it would be some headlines, Fox News, CNN, or whatever platform. We would be getting 20 phone calls, right, from customers, because they're more and more concerned about supply chain disruptions, port delays, and whatever else in between. So that has been a very enriching experience for us. A bunch of free marketing that we got. Obviously, we onboarded a ton of new customers and see, how we can help them manage financial risk and also provide the right insurance solutions.
Yeah, and thank you for that perspective. Now, Kyle and I are both obviously familiar with you and what Otonomi does, and how we partner together. I'd love for you just a quick disclaimer to the audience: when you're talking about your customers and the solutions you provide, how are you helping them from an insurance point of view?
Yeah, absolutely. So, as you said, right? So I'm Yann, founder and CEO of Otonomi. I created the company in 2021. So, right in the midst of COVID. And since then, what we've seen is probably the most volatile 5 years in history of supply chain, right? For a number of reasons. COVID was the genesis of it, but then climate risk has been a big factor. Then the trade tariffs, and so many of those items that we can discuss at length, if anything. So the product that I created with my team is really geared towards addressing a big issues in the industry, which is the fact that traditional insurance in marine and logistics is excluding delays straight. So if you have an issues, if you lose a ton of money, if you have some financial liabilities that you're trying to protect, your existing insurance contract cannot protect you. Otonomi is truly the only product out there that's geared towards essentially refunding and paying out claims for delay risks, right? And the product that we created is called parametric insurance, which is, in just simple term, we only care about one parameter, which is the transit time delays, right, from port to port or airport to airport.
Very interesting. And when we talk about, and to sort of, to some extent, what we're looking at here, the ups and downs, right? In this case, we're looking at demand activity, how many bookings are being placed on a weekly basis. And for the most part, global bookings took a brief dip right before the summer when there was all this sort of volatility. But we actually saw some slight increases in the second half of the year, especially for intra-Asia, so China to its neighboring countries, and for a lot of import activity going into Europe, that actually showed some increase. Meanwhile, these lower two visuals, U.S. import activity, so bookings for all containers going to the U.S., and especially the containers coming from China going to the U.S., has continued to show significant declines. Now, this most recent week, I think the year-over-year change that we're seeing is comparing it to the Chinese New Year, which was in a different week last year than it will be this year. But when you see this up and down from a week-to-week or month-to-month basis, how is it affecting you all and how you work with your customers?
Yeah, so I wanted to go back to one question you asked me a few minutes ago. So our customers are largely freight forwarders and shippers, right? So we do work with both cargo owners, BCOs, but also logistics intermediaries who are essentially managing transportation from A to B on behalf of exporters and working with carriers and also airlines, because we also navigate in the aviation industry. In terms of your questions, I think it translates a lot into seasonality for us, right? So we do have quite a bit of a calendar risk that we're managing, and that's essentially transpired the fact that we essentially servicing specialized industries such as perishable export out of South America, out of Southeast Asia. We also have some kind of seasonal calendar around e-commerce, and a lot of the hot season around the holidays, which is November until February, both Christmas, New Year's, and Chinese New Year's that's coming up. So we've seen a lot of ups and downs in terms of volumes change. And arguably, the China-U.S. trades has been showing some sign of decline in many ways. It doesn't mean that people are not buying. It more means the fact that it's been recalibrated, and people are actually establishing new trade partnership, right?
Yeah.
On that basis. So since we're a global team, a global company, the same way that Vizion is, we're seeing the volumes kind of like spreading out in different regions, but we're still seeing a lot of demands.
Yeah, no, that makes sense. Yeah, absolutely. I want to come back to a couple of things of what you mentioned around seasonality when we get to some of our further slides comparing year over year. Kyle, why don't we go to the global bookings over the last couple of years? And I think this echoes sort of the point that I was making earlier. Is we did see that brief dip in that being the blue line in 2025, but for the most part resumed to normal activity, maybe slightly below by a couple of percentage points where we were in 2024, but we were still well above where we were in 2023, right? 2024 being kind of a boom year, and not dipping below 2023 levels in terms of global shipping activity. So you're right, a lot of this is recalibration, maybe more imports coming into places like Europe, China's exports going to different destinations besides the US. And a lot of that has started to balance out, at least globally. Now, very different story on the next slide when we look at US import bookings and especially China to US. Now, US import bookings for quite some time were at levels not seen in the last 2 years, levels that low. So basically, we watch that green line, and when the blue line is below the green line, we see that we're well below those booking levels for the last 2 years. Now, fortunately, this year we've started to bounce back a bit, and we are going to see a dip in accordance to the Chinese New Year. But
next
so
week
far,
primarily.
yeah. But what's good is so far we're at least above 2023 levels, which was not something that we saw for any of the last 6 months of last year. Now, U.S. to China, I want to get your perspective on this, Yann, because we talk a lot about seasonality. We talk about the sort of peak season rush and what kind of late summer, roughly like July through early September, in terms of getting goods in prior to Black Friday, prior to a holiday, Christmas sales, things like that. That didn't happen last year. We basically didn't have a peak season. And from your perspective, as you said, working with forwarders, working with shippers who are responding to this new sort of demand from their customers, the cargo owners, are we at a point where the seasonality we would expect before has completely shifted? Is this like a totally new paradigm that we're in today, or is there some sort of expected behavior that we will remain even in this new scenario that we're in?
Yeah, it's a tricky question. I can give you my perspective in terms of risk management, which is essentially a result of a number of risk factors. Volumes is one risk factor, but pure volatility is probably like the primary risk factors that we are analyzing in terms of how we're calibrating our own pricing. And when it comes to insurance, we do have some model where we sell what we call on demand, which is similar to your API, availability for trade booking and track and trace. And then we have the same type of product where people can come in the way they want. So that's actually highly affected by seasonality and volumes. But most of our product customers are actually geared towards a monthly and annual subscription, right? So in that case, what you see is they really plan out a full quarter, several quarters, or 12 months ahead of time, because they know when they have to actually report back to their CFO or financial planning officer, that's going to be a lot of the, okay, we knew that this could be some annual volume we have to cater for. It turned out that the first quarter was a little quieter, but when it picks up in April, May, and June, we'd rather have enough capacity from, in terms of a risk capacity from Otonomi in order to actually, book more of the policy for delay insurance, right? So we see a lot of this thing where, regardless whether, some seasonalities could be shifting from a month to another, or sometimes it can be a quarter to another one. They still view that, their annual volume is still going to be remaining pretty predictable. And the risk capacity that they're going to be requiring from us is still going to be growing over time because volatility is growing at that point.
Yeah, no, that makes sense. And yeah, in terms of capacity and recalibration, I think the next slide, which we haven't normally shared before, but we had a few customers ask us to have side by side. We were just looking at China to US. We've consistently been below any levels seen in the last 2 years, while China to Europe actually remained not only relatively stable, in some cases we were seeing increases year over year last year in comparison to 2024. So much more stable, much more resilient. Obviously, there wasn't as much of the tariff disagreements and the threats back and forth like we saw with China and the US threatening 150% tariffs. So, from your perspective with your customers, has there been this realignment where you can rely on a trade lane like Asia to Europe that, at least according to our data, appears to be more stable?
Yeah, we've seen some of it to a good extent in specialized industries such as automotive, for instance, right? So the heavy Benelux, Germany, and kind of Western European economy complex when it comes to heavy industries such as automotive and other kind of machinery production has been pretty steady in a sense of kind of output itself. But in terms of trade lane and trade volatility, outbound from Asia into Europe has been increasing, right? So we've seen not only more volatility but more concern, right? Which is kind of the positive factors in how the customers are perceiving our product, to help them manage the risk, but also in general how the results are panning out, right? So we've been seeing quite a bit of volatility increase, but that translates into claims payments, right? Which is what the customer wants when they contract insurance. So which is to say, we've been making many more customer happy, right? With this kind of context.
Absolutely.
Curious, sir, quick question. We've been following closely how capacity on the trade lanes have been changing week over week. Mm-hmm. Also, of course, how rates and indexes have been changing week over week. Mm-hmm. There was an attempt to kind of spike ocean rates at the beginning of this year, which failed. And now we're actually seeing a pretty sizable collapse, even to the point of, for some of the lanes, it's getting below the cost of the carrier to actually move it. Mm-hmm. And so, Maersk announced a forecast of a potential EBIT loss of this year of 1.5 billion. And curious, is this something that you would say factors into that volatility? Because it's somewhat predictable in some sense, because that capacity management and shift in demand are mm-hmm. forcing the carriers to rejigger their, not networks per se, but their mm-hmm. services. So it's somewhat predictable that these rates are going to be declining, but perhaps the not predictable element is how are the carriers going to manage this, which the biggest lever for them to pull is blank sailings, or artificial capacity management. So how does that play into the insurance game when the rates are changing so much?
Yeah, it's kind of the $1 million, $1 billion, $1 trillion question you're asking. So one of the things that you essentially put to the conversation is blank sailing or rollovers, right? So this is kind of the tug of war.
Blanks on a much smaller scale, the rolls.
Yeah. And so this is kind of the logistical risk that our ocean customers are coming us to actually mitigate, right? So a lot of what we do is essentially helping them, kind of articulate, the kind of logistical risk and delays that is suffering, and really structure the product they need to actually implement with us, right? But as you said, right, there's a little bit of manufacturing behind the scene, because if large tier one ocean liners, Maersk, CMA, are actually perceiving kind of a drop in some of the trade lanes, then they're going to be managing output on their end to maintain, right? So supply and demand type of economic reasoning behind it. So for that perspective, it does seem that regardless of the volume, the trend and behavior of shippers and exporter can be relying on the schedule and the booking is still going to be even kill or even worse, right? And in that case is where we come in. We're really trying to actually floor the risk that those exporters are risking by working in those really volatile environments, and trying to smoothen out the potential financial loss when they have to really cope for a certain deadline with the consignee, with certain large retailers like Walmart or whatever that are extremely hard in terms of SLAs and just-in-time delivery, right?
And the Trans-Pacific route, it's still the most meaningful, if not the top 3 most meaningful trade lane routes for ocean freight. Mm-hmm. But with the softening demand, some seeing it drop as much as kind of 20%. We've been looking at it the past few charts here. Mm-hmm. It's been interesting to see the collapse in rates, because last week we were forecasting like a rates collapse of like 25-30%. But now we've updated that to the Trans-Pacific rates should be dropping 50% now.
Wow.
Where they currently are.
Yeah.
So something is worth watching here.
Yeah.
And
no,
it's
so
really
I want
to see how the players respond.
No, I want to actually agree 100% with what you said. There's a subset of trade lanes that are clearly not of interest or less of interest to certain customers. And I heard about this Shanghai to Port of LA, Long Beach.
We took it like Yantian a lot to LA as well. Yeah.
So that one, we're not going to be selling the product, right? They're like, oh no, we got 9 days or 12 days, like crazy, super fast, reliable, especially with the drop in volume. So that's going to be a case by case. And then we can talk about global macros a lot. What we deal with is a lot of micro risk, right? So idiosyncratic risk. A few days ago was the anniversary of the Maersk Saltoro, the Cherry, containerized vessel that's kind of state stock equipment failures in the Pacific that created $300 million worth of liabilities for exporters for the Chinese New Year's, right? So those risks are actually sometimes more traumatic to exporters than the global macro risk, which obviously everybody hears about it all the time.
Yeah.
And I'm curious, there was another story, I think it was from like September, October, into last year. I believe it was the Zim Express service from Far East to like LA. I think it was the Colorado vessel named Colorado or something to that effect that had a vessel fire. And so it was like 2 or 3 days east of Japan and had to turn around and go back to Korea to get inspection and repairs, which led to that express lane getting increases of like up to 10 days into the delivery. That sounds like the kind of scenarios Otonomi is more focused on, right? That, as you said, a much smaller scale, meaningful to a specific voyage type of insurance, not the it's tough to deal with the macros and from a business model perspective.
Yeah,
exactly. Yeah.
I want to go maybe with the last. This is a great discussion, and Kyle, maybe what we can do is go to the second to last slide. Sorry, the one on import port performance for LAX. Now we had other things related to India and US that maybe we can share in a couple of weeks. But Yann, our discussion about capacity constraints and depressed rates makes me want to go right into performance, especially seeing what you all do with ensuring the risk of delay. I've talked to many folks who are newer to the container shipping industry. And when I think about reduced demand and increased capacity, which is what's happening right now, they think, oh, well, then performance should be much more reliable. The ports shouldn't be congested. The transit times should be shorter. Like, why is this not happening? And there's clearly some sort of disconnect in a naive person's mind, thinking that demand is low, there are less containers being shipped, or increased capacity, more vessels being brought on board, with the thought that things should be more efficient and there should actually be less of a risk of delay. And that's shown in what we're seeing right here. Now, this is a port performance snapshot, something that Vizion puts together using the TradeView data that shows just in the last 30 days, the import port performance, meaning the amount of time it's taking for LAX, the largest US container port, to receive a ship, unload a container, and get that container picked up, has skyrocketed. It's almost to a high that was seen back in October of over 4 days, meaning the amount of days between vessel arrival and container gate out. Now, what's your commentary to someone who would think that low booking demand, low import volumes, increased capacity, the ports should be more efficient?
Yeah, I think it's a little bit of a follow-up from what we just discussed with Kyle, right? I think there's a definite kind of recalibration of port operations, and it's a one-off each time, right? Each of those terminals, they're going to be making their own decisions. But if you're already forecasting drop in volumes and revenues, then what is the likelihood that you're going to be maintaining the amount of staff in order to operate lower volumes? So I think they almost like looking at maintaining the delay at port in order to essentially counterbalance OpEx versus revenue, and therefore we're not expecting improvement at all. And it's actually like some of the trends we also recognizing in Asia Pac, right? It's not because there's could be some recalibration and lowering volumes in certain ports that it's going to be like smooth sailing, so to speak, right? So we've seen that in other regions.
Yeah, labor is, I think, a really interesting one, especially considering U.S. ports, which are not fully automated, right? Which are heavily reliant on human labor, unlike ports in Asia and in Europe, where you're right. If the revenue's not as high as it was, then the staffing isn't there, and therefore the containers might not be moving through the port as efficiently as you would expect them to, even though volumes are lower than they've been historically.
Mm-hmm.
And this is, of course, import port performance. I think we want to end on the export view for a key port in Europe, so Rotterdam. This is how long it's taking containers when they come into the port to get loaded onto a ship, and for that ship to actually leave from its origin in Rotterdam. And that's now at a point of over 8.5 days. Now, we did see a high just in October. It seemed to be returning to a more normal and stable level. And beginning in December, we saw that begin to skyrocket. Again, not a peak season. This is not a time of year where you expect tons of containers to be getting shipped out of Rotterdam. And yet, for some reason, we went from 8 days up to 12 days at the beginning of the month. Very high. It's starting to sort of reduce and balance out a bit. But certainly something from a risk point of view, for a shipper or a forwarder who's thinking, do I need to insure my cargo? Are things kind of stable? When we think about exports going out of Europe, it looks like there really isn't much stability, at least in the last 30 days.
Yeah, I can tell you that much. This kind of visibility, it's not visible to most of our customers, right? So I think you guys are doing a terrific job in really creating transparency, going the extra mile of analyzing the data, presenting it very clearly. So what we're working on is actually somehow replicating on the risk and financial side what you guys are doing, because this is so important for exporters, for freight forwarders that don't have the right tool for it, don't have the budget to have software in order to make decisions, and also implement some risk solution adapted to it. So it goes across the chain, track and trace, visibility, but also insurance and risks.
Well, it sounds like that has clearly been a need for quite some time in the air freight space, where you all initially started. And what's happened, like you said, beginning in 2020, but especially even just in the last 10 months, in the world of container shipping, being able to insure your cargo, the risk of delays, that's now more of a need than ever before.
Absolutely.
Complexity increasing, the different levers that create risk are, it seems like, expanding in count. Like there's more things we are worried about now than say 10 years ago.
More dimensions of risk. Yeah.
But Jans, thank you so much for your time today. We really appreciate the great insights from the insurance perspective. As you kind of mentioned, visibility is improving across the industry. It's getting deeper, more detailed, and I think for both of our companies and the industry at large, it's beneficial because that means models are going to get far more precise, more capable, et cetera. And really the next step is predicting out these types of performances in the future. So looking forward to the future of our partnership and looking forward to what that's going to mean for the industry at large as well. So thank you so much for your time today.
Yeah,
thank you for having me. That was a pleasure. We'll be in touch very soon.
Thank you to our audience. We'll see you again in 2 weeks. Bye-bye.
Cheers.